Good evening, everyone, and welcome. Could you give us a quick mic check? Are we audible to you? So here we go. As always, good evening, good morning, or good afternoon, wherever you are joining in from, and heartiest and warm welcomes to everyone present here. Thank you for joining us. And well, this one is a special broadcast as we close out the year with what is, for us, one of the most important sessions that we are going to host. So, on behalf of Lampros DAO, I want to extend a very, very warm welcome to all of you for tuning in. Whether you've been following Arbitrum closely throughout the year or you're joining us for a broader ecosystem perspective, we are wrapping up the year and this one is special. And what's more special is that we are glad to have you here.
So for those who are new to our work, we are Ramplos DAO. We are a team of builders, researchers, and analysts focused on turning on-chain activity into clear, data-backed insight. Our work sits at the intersection of governance, economics, and ecosystem behavior. We don't approach these topics through opinion or narrative first. We start with measurement because governance, decentralization, incentives, and participation are not abstract ideas. They are leaf traces on chain, and those traces can be analysis.
You're right, Smriti. And I think that is the reason that sessions like these matter. So, tonight's broadcast, my friends, is, as you would see, titled Arbitrum in 2025. And it is deliberately done so. We have framed it as a full year retrospective. This is not a highlights reel, and it's not going to be a technical deep dive, because if we did a technical deep dive, that would have been way too long. But instead, we have structured something for you, a sort of an analytical look, a skim at what actually happened across the Arbitrum ecosystem over the last 12 months.
So, if we talk
Talk
about
about 20.
2025, it was not a quiet year for Arbitrum. It was a year where scale met structure, network activity matured, economic patterns become clearer, governance processes were stress tested in real conditions, and the ecosystem expanded not just in size but in complexity as well. These shifts are visible when you zoom out, and that's what exactly we will be doing today. Over the next hour, we'll zoom out and look at Arbitrum's 2025 from a few key angles. We'll start with the headline numbers, then dig into how network activity and economic health evolved beneath the surface. From there, we will look at how ecosystem chains and DeFi activity actually behaved in practice, where users concentrated, and what patterns emerged. We will also walk through governance across the year, touch on major technical milestones that enabled this scale, and highlight how the DAO deployed capital through grants. And then we will close with the risk, lessons, and signals the data is giving us as we head into 2026. Towards the end, we will briefly touch on Lempros DAO's own contribution these years, the dashboard, analysis, and the research we have shared with the community, not as promotion, but as a part of the broader ecosystem story. The goal tonight is simple, to leave you with a grounded understanding of where Arbitrum stands today, how it got here in 2025, and what trajectories are beginning to form as we move into the next year.
Thank you. Thank you so much. That sets the stage correctly. So, shall we dive in?
Yeah,
L-
sure.
So, let's go. Let's begin with an overall snapshot. So, here's what happened in 2025. So, towards the close, Arbitrum is closing 2025 with a peak TVL of $19.21 billion, up to 330% from end of 2024. Now, the network has also processed 2.16 billion transactions, captured 37.1% of layer 2 market share, supported 1.45 million active wallets, and has seen $27.5 billion in bridged volume across 17.3 million transfers. And all of this, it comes from 4 million users. Now, at peak, that translated to roughly 3.4 million daily transactions. Imagine that every day, and with average throughput around 17.4 transactions per second and bursts up to 1105. I know these are a lot of numbers, but these actually are indicative of the scale at which things are happening in Arbitrum. Now, if we look at economics, applications generated $73.8 million in the quarter one revenue, while quarter four, the ending of this year, brought $25.8 billion in net inflows. Now, Time Boost contributed over 2 million in early fees. Stablecoin TVL exceeded $5.6 billion with USDC at roughly 58%, and more than 1.2 million smart contracts were deployed in the first half of the year. Now, on adoption, Orbit Layer 3s showed clear concentration. The top three chains captured 72% of revenue, with the DeriW chain at 41%. Institutional real world asset activity expanded. This included Robinhood's tokenized stocks as well, while daily active usage held steady around 470,000. Now, let's move from the snapshot to how this activity actually built over the layer. Let's break things down a little and skim over them fast. Smriti, if you may.
Yes. So this was a quite information. So let's begin with the network activity and economic health, because this is where the year story becomes clear. 2025 was Arbitrum was not defined by a single spike. It was defined by compounding capitals, users, and uses built quarter by quarter. And by second half of the year, the network was operating at a completely different scale than where it started. So, as we talk about the quarter one, growth was steady and disciplined. Applications on Arbitrum 1 generated USD 73.8 million in fees. TVL climbed to roughly USD 3.39 billion and USD 4.6 billion in bridge. Deposits reflected early capital positioning. Daily active wallets trended toward 470K, supported by low fees. This was stable usage forming the base layer, not speculative churn. Quarter 2 marked acceleration. Cumulative bridge volume crossed USD 27.5 billion, driven by 17.3 million transfers from nearly 4 million users. TVL expanded rapidly to USD 8.6 billion, a huge 330% increase versus end 2024. That's a huge number. Average throughput held around 17.4 transactions per second, with peaks up to 1105, showing sustained demand without systematic stress. This was the shift from recovery to momentum. By the end of the first half, market leadership was clear. Arbitrum captured 37.1% of layer 2 market share. Active wallets leads 1.45 million, more than 1.2 million smart contracts had been deployed. Stablecoin supply crossed USD 6 billion. Revenue sources began to diversify, with early time boost fees contributing alongside application activity. If we talk about quarter 3, Arbitrum reached peak sale. TVL hit all-time high of USD 19.21 billion, while market share held at roughly around 37.1 percentage network uses, around 3.4 million transactions, and around 470K active addresses. And importantly, this activity persisted through the quarter. If we talk about the quarter four, it was about consolidation at scale. Over the final 3 months, the network recorded USD 25.8 billion in net flows. Active wallets remained at 1.45 billion. Stablecoin TVL exceeded USD 5.6 billion, and the core metrics stayed resilient despite broader market volatility. Looking at the second half and the full year, Arbitrum sustained TVL around USD 19 billion, maintained 37% plus layer 2 dominance, exceeded 1.2 million smart contracts deployed year to date, and continued to diversify the revenue streams. So, stepping back, 2025 was a landmark year. 2.16 billion transactions, USD 19.21 billion peak TVL, 37.1% market share, and 1.45 million active wallets. From quarters one foundation to second half consolidation, pattern is consistent. Arbitrum didn't just grow, it matured. So now let's look at that, how this activity is distributed across the ecosystem chains.
Wow, that was a lot of numbers. So let's just break the ecosystem chains down. Look which ones were at the top, how people adopted and everything. So after looking at the base network, things are starting to get interesting here. In the past year, Arbitrum's ecosystem chains did not grow evenly. They organized. Orbit layer 3s began to separate into leaders, some became followers, and some chains were treated like experiments. And this whole structure tells us a lot about how the ecosystem is actually being used. Now, if you look at the first quarter and the early part of the first quarter, the signal was immediate. Revenue did not spread out equally, it clustered in parts. Now, DerryW pulled ahead fast, generating more revenue than the next few chains combined. Now, Rari chain followed with a very different profile. There were fewer batches, but the batches that were transformed were heavier ones. The third one to complete the leading group was the Rogue chain. Now, in the end of quarter one, roughly 72% of Orbit revenue was already flowing through this small cluster only. Now, imagine the map forming such early during this stage. When we entered quarter two, these roles did not blur. In fact, they locked in. DerryW became the engine for continuous activity. Rari chain followed and remained the premium venue. And gaming chains, especially Ape chain, they started to show up with real usage. Now, this pushed Orbit beyond purely financial workloads. Now, even as more chains launched, one would expect that concentration would also get distributed, get decentralized of sorts, but concentration barely moved at all. The top still captured about 72% of fees, but this time a mid tier began to appear underneath them. Not very, like not the majority of the fraction, but definitely consistent enough to matter. Now, when we entered the second half, the ecosystem had shifted again, this time towards maturity. Network upgrades reduced latency massively, execution became more reliable, and the use case of the entire mix sort of widened. Now, gaming workloads grew more complex. Real world asset experiments were also starting to become visible. Non trading activity, more specifically, took up more of the layer 3 block space. Now, here comes a key point. The top heavy structure did not look fragile anymore, it sort of looked intentional. Concentration reflected product maturity and user choice, while DAO grants kept the middle active and prevented stagnation. So, if we look at the entire picture and the data that all of these chains produced, one must ask that what does the chains data actually say? Now, leaders emerged, and as we see, they stayed the leaders. A middle class in the story somewhere, it began to form. The long tail was formed of the chains that people kept experimenting with. And Nova, on the other hand, quietly absorbed the high volume, cost sensitive work that made the whole system actually smoother. This isn't an early system or an early ecosystem anymore. But at the same time, with all of this organic activity spread around, it isn't finished either. It is organized and it is making room for what comes next. Now, Smriti, what would you say comes next? What layer would you like to explore after this?
So now let's see how that structure shows up in decentralized finance and trading behavior. So the base layer story in 2025 was about scale and stability. Decentralized finance shows us that scale was actually used. And here, signal is structure, not chaos. In quarter one, that structure formed quickly. Spot trading volume concentrated around Uniswap, which cut across trader sizes, while GMX led the derivative side, especially among high value participants. Trading activity was heavily skewed. Whales accounted for roughly 98% of the volume and about 60% of the fees. Trading pairs were conventional, USD with and USDT dominated. Entire pairs dominated, and these flows were a major driver of the USD 73.8 million in application fees generated during the quarter. But beneath the surface, something else was happening. Retail participation begins to show up. Smaller traders, shrimp and fish, increased on-chain activity, helped by extremely low execution cost. Even for whales, average fees stayed around 0.000033, reinforcing Arbitrum's role as a low-friction execution environment. If we talk about lending, behavior was conservative. RVV3 emerged as the dominant venue, signaling a preference for established risk frameworks over experimentation. So, if we look at the quarter two, didn't disrupt this pattern, it reinforced them. Whales still dominated, accounting for about 97.7% of trading volume, but middle of the stack started to matter more. Dolphins and sharks showed better retention, suggesting participation was becoming habitual rather than episodic. Uniswap remained central, while native venues like Camelot anchored, anchored liquidity in ecosystem specific pairs. Together, this mix supported volume growth without fragmenting liquidity.
You're right. And if we look at the second half, I think the focus shifted from leadership to sort of resilience. Protocol preferences have stayed consistent throughout if we look at patterns. Uniswap is on spot, established venues across derivatives and lending, but the ecosystem around them has deepened as well. Now, stablecoins reached multi-billion dollar scale with USDC clearly dominant. Now, that liquidity base supported more diversified strategies and reduced reliance on a narrow set of whale driven flows. Retail participation didn't replace whales, but it did expand steadily, adding depth rather than volatility. So, what does this decentralized finance data actually tell us? I think, in my perspective, it means that leadership consolidated around trusted protocols. While, I mean, whatever it is subjective, whether it is a like or a dislike, but whales remained structurally important. Stable coins also became the liquidity backbone, while retail growth was gradual, not at all speculative. Now, in short, if we look, Arbitrum's decentralized finance ecosystem behaved like infrastructure and not a simple trade, which was, optimized for efficiency, consistency, and scale. Now, if you may, let us turn to governance, where these economic patterns kind of met real decision making. Let's go. Yeah,
Yeah,
sure.
sure.
So,
So, if we talk about governance, in 2025, Arbitrum's governance showed clear signs of a DAO that is maturing and becoming more structured. Decision making flowed through a two-layer system, with Snapshot used for off-chain community signaling and Tally used for on-chain execution. of approved proposals. Over the year, the Arbitrum Foundation Snapshot Space processed around 55 proposals, reflecting steady governance activity. Community participation remained strong, averaging 2 to 4,000 votes per proposal, and approval rates were high across most initiatives. These snapshot outcomes translated directly into on-chain governance through Tally. The DAO executed around 18 major on-chain proposals, including approximately 12 constitutional AIPs. These votes covered protocol upgrades, treasury transfers, quorum adjustments, security frameworks, as well as ecosystem funding programs. Most constitutional proposals passed with over 200 billion ARB in voting power, typically involving 2 to 5,000 on-chain voters per proposal.
Wow, I mean, that number in itself is quite significant. So if we see that, I mean, it's from a starting treasury balance of roughly $1.2 billion, the DAO deployed more than 300 million over the course of the year. Now, this capital was primarily allocated to grants. There were incentives, audits, and ecosystem development programs as well. While engagement remained high, governance analytics continued to show voting power concentrated amongst the largest ARB holders. I mean, I think it did underscore an ongoing decentralization challenge. Well, despite all of that, I feel the year opened strongly in quarter one. The January snapshot proposals addressed Nova fee adjustments, they addressed sustainability goals, they addressed watchdog bounties, and of course, the DAO Season 3 elections across gaming, developer tooling, education, and innovation. Now, these proposals moved quickly on chain, resulting in the activation of the Arbitrum Bold and Infura Nova validation, the launch of OPCO as a DAO adjacent execution entity, along with the approval of Stable Treasury Endowment Program version 2. If we look at February, the DAO approved funding of the Stylus Sprint Committee and formalized the Domain Allocator Offerings Grant Program, both of which were executed on chain shortly afterwards. Now, I think March closed the quarter one, with governance and security upgrades, including the Arbitrum audit program and Time Boost Plus Nova Fee Sweep constitutional upgrade. Now, one proposal, the Arbitrum onboarding version 2, which we spoke of, it failed to reach quorum, standing out as one of the few on-chain rejections of the year. By the end of quarter one, approximately $45 million had been deployed, largely towards early step grants and I think foundational governance infrastructure. Governance activity, if you observe, it actively accelerated in quarter two, with several high impact proposals moving from snapshot to tally. Now, on-chain executions during this quarter included the ARB OS 40 Callisto upgrade, the launch of the Watchdog Grant Misuse Bounty Program, and a decentralized finance renaissance incentive program, which was very fondly called DRIP, a constitutional reduction of the quorum thresholds, and a Sky custom gateway registration. Now, while some snapshot votes exceeded 3,600 participants, the on chain participants or the participation dipped sharply in April to just 311 unique voters. I think this was the lowest point of the year if we observe the entire mapping. Treasury outflows in quarter two totaled around $120 million. I think this was largely driven by incentives and a step phase 2 allocations. What would you say about the second half of 2025?
If we talk about the second half of 2025, it demonstrated the DAO's ability to operate at greater scale and complexity. In July, governance reached its highest proposal volume of the year, executing constitutional measures to register the boring token, update the upgrade executors framework, and approve multi-year funding for Anthropy advisors. August followed with a major constitutional proposal, removing cost caps and refining executor controls. In September, governance attention shifted towards security and protocol resilience with the execution of the ARBOS 50 DIA. updates to the Security Council election process, and 8.5K ETH treasury transfer. The final quarter focused on governance refinements, including guest target adjustments, AGV elections, compensation update, as well as delegate reconfirmation, before closing in December with red delegate appointments and the pending execution of ABOS 51 DIA. Across quarter 3 and quarter 4 alone, the Dow deployed approximately USD 380 million, with funding heavily weighted toward grants and long-term ecosystem growth. Snapshot participation peaked at around 42,000 unique addresses, and the Security Council was formally seated following the year's election process. Overall, Arbitrum's governance in 2025 reflects a DAO coming into its own. Treasury deployment accelerated, constitution safeguards were enforced on chain, and coordination between the snapshot signaling and tally execution tightened. While decentralization remains an open challenge, the governance system proved itself increasingly structured, enforceable, and resilient.
So, if anyone has dozed off, you can actually wake up now. The long jargon names are over. We're out of governance and now we are on to technical upgrades and milestones. So far, we've looked at activity, capital, and even behavior of the components of the ecosystem. Now we turn on to what made that scale feasible. These are the technical milestones that quietly shaped Arbitrum throughout 2025. Why do these matter? Is because this year's growth was not at all accidental. It was not something of a fluke or anything that was random. This was enabled by a series of incremental and well timed infrastructure upgrades rather than a single headline release. Towards the end of the year, we all know about the famous Fusaka upgrade. This was the second one that came within a span of half a year, and we have made a series of 2 episodes exclusively covering this. You can check that out on our Twitter account as well as on our YouTube channel. So Fusaka focused on tightening Ethereum compatibility. It reduced gas costs and strengthened the core infrastructure to support faster ecosystem expansion. Now, it was not designed to change user behavior overnight. Instead, it improved developer ergonomics and execution efficiency, exactly the kind of upgrade that compounds quietly rather than announcing itself through sudden spikes. Now, earlier in the year, Time Boost was introduced as a part of Arbitrum execution layer evolution as well. Now, Time Boost enabled faster block times and introduced a new fee mechanism. By June of 2025, it had already generated over 2 million in early fees. As it noted in the Arbitrum's Foundation's half years of the first half progress update. The importance here wasn't raw revenue, but it was the signal that it gave. Execution layer innovation could in fact translate into sustainable and protocol level income.
Also, in the first half of year, AppOS Callisto shipped with important Ethereum alignment features. Callisto added support for Ethereum Spectre upgrade path, incorporated roll-up level benefits associated with photo rank sharding, and kept Arbitrum closely synchronized with Ethereum's evolving roadmap. These changes reinforced Arbitrum's positioning and as a roll-up that scales with Ethereum, not away from it. Through the year, Bolt continued processing towards permissionless validation. Multiple milestones were reached through pilots and governance sections, and constitutional AIPs ratified key components of the sequencer decentralization roadmap. Full decentralization remains a multi stage process, but 2025 marked concrete forward movement rather than stated intent. At the ecosystem level, the optics saw continuous enhancement. By the end of 2025, more than 96 ecosystem chains were settling on Arbitrum 1, with 54 named mapped and actively tracked. Latency improvements and execution optimization enabled more demanding workloads, particularly gaming, and real world asset use cases, and directly supported expansion observed in the L3 activity.
Right. If we observe fully, taken together, these upgrades kind of underpinned Arbitrum outcomes in 2025. It sustained high transaction throughput without degradation. And I think what that means is that this was the infrastructure that was doing its job. It was mostly invisible, but that is what formed the essential layer beneath everything that was happening. Now, beyond what shipped, several technical trends became clearer over the year. Stylus momentum continued building as developers experimented with Rust and Wasm smart contracts, pointing towards future performance gains beyond traditional EVM constraints. Sequencer decentralization advanced through governance proposals and test phases, laying groundwork for improved resilience. Ethereum alignment always remained a priority, with ArbOS updates tracking features like improved account abstraction and rollup optimization. Along with this, at the same time, Orbit customization increased as chains tailored execution environments for gaming or real world assets, and there was also uprising in specialized decentralized finance. Validator and fraud proof systems evolved quietly, supporting higher throughput without compromising the entire optimistic rollup model. If we look at the technical story of Arbitrum in 2025, it is not very dramatic reinvention. It is about execution discipline. It is planned, it is channeled. Now, upgrades that were shipped on scheduled, they stayed aligned with Ethereum and scaled alongside real demand. Now, that discipline is what allowed the ecosystem to grow rapidly without any fragility. And I think that is what sets the stage for what comes next.
From technical upgrades, let's move to the DAO grant programs. So in 2025, Arbitrum didn't just scale technically, it scaled how it funds and support builders. That shift showed up clearly with the launch of DAO Grant Program Season 3 in March. Instead of short stop-start funding rounds, Season 3 became a single year-long program and the main entry point for DAO-backed funding. The program now runs across 5 domains, including a new orbit chain track and capped in its milestone based model. Teams only get to paid after they ship. What changed was accountability. A portion of every grant is now held back until teams report on real post grant impact. Funding scaled with the structure. The programs allocated USD 6.75 million for the year. By late 2025 had already processed 900 plus proposals, approved over 100 projects, and distributed more than USD 1.5 million. Season 3 marked the shift from experimentation to a repeatable funding machine. Builder support extended beyond grants. The Arbitrum Open House launches a global onboarding program starting in India and culminating in a live hacker house in Bangalore. Moved builders from learning to building to shipping and plugged top teams directly into the Arbitrum ecosystem.
Nice. That is spectacular. But at the same time, on-chain labs launched as a hands-on innovation effort from off-chain labs under Foundation. Its goal was extremely simple if we understand. It set out to help early teams build real products, avoid extractive launches, and focus on adoption more than hype. Now, on the decentralized finance side, the DAO introduced DRIP as well, which we discussed, the DeFi Renaissance incentive program. Unlike older incentive models, DRIP rewarded real financial activity, not surface level metrics. Season 1 allocated up to 24 million ARB and focused on leveraged decentralized finance strategies. It drive it sort of is driving measurable growth in lending and stablecoin usage as well. Now, if we begin to close the loop on accountability, the DAO launched Watchdog, a grant misuse bounty program. Anyone can report suspected misuse completely anonymously. Valid cases are rewarded, and funds have already been recovered. Finally, out of all, the governance itself was reinforced through the delegate incentive program, which pays active delegates for consistent participation. Thus, it ensures decisions are made by the people who actually show up. For me, the takeaway is extremely simple. 2025 was a year where Arbitrum didn't just fund growth, it built systems around it. And that I think is very essential. Builders were supported, incentives were targeted, and accountability was enforced. Now, that is, my friends, what an ecosystem looks like when it moves from growth to durability.
So let's
Let's
now
now
talk
talk
about
about
the
the contribution of Lampro's DAO, data dashboards, file books, and all. So picture this: early 2025, orbit chains exploding, but no single dashboard tracking their activity in real time. We fixed that. Our Arbitrum orbit chain dashboard went live, covering ape chain, Con, Digin, Plume network, giving you a chain level TVS breakdowns, externally bridged, natively maintained canonical volume, near real time updates, community driven improvement. It's a single pane of glass for healthy growth. For revenue tracking, Arbitrum ecosystem revenue from Orbit chains now monitors 96 chains settling on Arbitrum 1. Among them, 54 have been named named, 42 identified as unknown, plus 45 chains on Ethereum. Daily revenue per chain, average per batch, top contributors leaderboard. We started small, expanded continuously. Small chains, mid-tier giants, as well as all verified before going public. So, if we talk about trading intelligence, we have this Arbitrum trader segmentation and activity overview dashboard. Deals driving 98% of volume mapped trends at 57% of the traders at 0.01% volume segmented. Trade frequency, buyer preferences, fee contribution across cycles. Even individual wallet patterns, live, maintain, actionable.
That goes to show the wide variety of things that we have covered and our commitment to Arbitrum throughout the year. All of these dashboards, all of these contributions you can find through the posts that we have made, and as well as through our websites. There are detailed reports about everything as well. Do check them out. I am sure you will be enthralled by looking at those. But we did not finish at dashboards, they were just the start. We rolled up our sleeves in open source. Dune Spellbook, we did 25 plus pull requests across 10 months. January kicked off with FragSwap, Chronos, CyberSwap in RPRs. February had OSS Swap, Swap version 2, WooFi. June through October, we had Acron Swap, Gains Network Perps, Elk Finance, Sushi, Graphene, and even Orbit token monitoring for Degen, Plume, and Con. Now, protocol level SQL, sector classification, all of it, clean data powering your analytics. That is what Lampros DAO did. DeFi Llama got the same treatment. In November, variation TVL versus fees, InstaDApp, ArbDefects. December, we sort of went on a blitz. App chain TVL, chain fees, Aspecta revenue, Everclear twice, Rari, Capex, Sanko, Adventure Layer, AlienX, Dairy Chain, the list goes on. Metric fixes, verified PRs, all of this so that your DeFi dashboards run smoother because of our grind. Community, we showed up. The broadcast series that you're watching right now, we began months ago. We've had several broadcast spaces, and through not this was not only for our dashboards, this was for protocols, for upgrades, for everything that was happening in the ecosystem. And apart from that, we had weekly fee signals, activity trends, monthly pattern mappings, conversations, and report releases, you name it, and we contributed to the community. So just a tiny signal. This is not like a shameless plug where we're promoting ourselves. This is to show that come together with us and let us, you know, d- contribute to the community together. So over to you, Smriti.
Okay, so if we talk about the weekly cadence that you love, 25 plus analysis post, Week 35 to 50, top 10 fee generating contracts on Arbitrum Fund. Top 10 revenue opportunities. Monthly recaps for September, October, November. Every tweet links back to the dashboard. Data team rigor, community rhythm. The crown jewel, LTIPP research bounty. Full analysis across tax, bridges, perps, wallets, RWA, gaming, and infra. How incentives drove user growth, liquidity, retention, but also mercenary behavior and spillover to non-recipients. 8 deliverables, 2 research reports, 2 statistical analysis, including t-test, regression clusters, as well as synthetic controls, Dune dashboard, dual pattern visualization app, avocation tracker, key takeaway docs, links in thread, ecosystem changing work. This wasn't solo. Community feedback shaped every dashboard iteration. Broadcast, broadcast sparked because you tuned in. Lampros DAO in 2025, 3 lakh broadcasts, 25 plus spellbook PRs, 13 plus DeFi Llama adapters, 7 plus community session, 25 plus weekly analysis, 1 bounty crush, not just contributions, infrastructure for Arbitrum's data golden age. As Arbitrum scaled in 2025, some of the most important signals came not from metrics but from governance discussions in the forum.
Uh,
Over to you, Arijit.
So, while all of this was happening, we received a post on the 9th of April, if I'm not wrong. Yes, on 9th of April 2025, the community published a vision for the future of Arbitrum, a strategic reset as the DAO entered its third year. Now, this gave us some really wide perspectives. The post acknowledged real success, mature on chain governance, large incentive programs. There was active treasury development and a growing ecosystem of support structures. It also named the trade offs of scale. There was slower execution, proposal congestion, and increasing pressure on volunteer delegates. The response was very structural. The vision centered on Arbitrum aligned entities or AAEs, including the Arbitrum Foundation, Off Chain Labs, OPCO, the Gaming Catalyst Program, and of course, Entropy Advisors. Now, under this model, the DAO sets direction and approves major decisions, while execution shifts to aligned operators with clear mandates. OPCO becomes the operational backbone, and the Oversights and Transparency Body, or OAT, provides this one provides elected monitoring and accountability. Now, the goal overall is to reduce governance friction and improve the execution speed without weakening the DAO control at all. So, what would you say about this, Smriti?
okay,
Okay,
so
so if we talk about the progress that was made in H1 2025, that is the first half of 2025, that shift showed up clearly in the foundation first half progress report. In H1, the foundation approved 56 grants and strategic partnerships across DeFi, gaming, infrastructure, and orbit related projects. Programs like Trailblazer 2.0 and Arbitrum help teams move faster to market while stablecoin supply across Arbitrum chains exceeded USD 6 billion, alongside milestones such as Robinhood's tokenized stock launch. If we talk about on the technical side, the foundation supported DAO approved upgrades, including Time Boost, expanded client support via Ericon and Nethermind, AppOS Callisto for Ethereum factor alignment, and Bolt for dispute resolution, strengthening performance, decentralization, and development experience. Developer outreach also expanded globally through workspace, hackathons, major events, and programs like Arbitrum Everywhere. The Ambassadors program growing to 7 regions.
Wow, 7 regions is quite a big area, even geographically. But if we talk about key governance theme in 2025, it was the Stable Treasury Endowment Program, or STEP for short. This shifts treasury management towards more of a tokenized and yield generating real world assets, primarily for the US treasuries that remain liquid and composable on chain. Today, STEP operates with a broader treasury framework coordinated through the Arbitrum Treasury Management Council, strengthening capital preservation, yield strategy, and transparency. But with all of this, the bottom line, I think, is that these forum threads show a DAO that is actively professionalizing itself. It is clarifying roles, it is improving execution, and it is building durable financial infrastructure to support growth at scale.
So let's talk about the risk and insight. What the data cautions us about. Arbitrum's 2025 data tells us a story of rapid maturation, but also of growing structural concentration. On the surface, the signals are strong: revenue growth, deeper infrastructure, and expanding orbit adoption. Underneath, however, revenue, governance power, and trading activity are becoming increasingly concentrated among a small set of actors. This isn't a failure state, it's a classic scale challenging. So, if we talk about the revenue concentration across the Orbit Layer 3 ecosystem, revenue is sharply top heavy. The top three Orbit chains captured 72% of total weekly revenue, with W alone accounting for 41%, more than the next two combined. Rari and Rogue followed at a distance. While a mid-tier group of chains each contributed just 2 to 3%, indicating experimentation, but no additional breakdown leaders. Rari's profile is instructive. Its revenue is driven by high gas specialized batches, running at 2 to 3 times average gas usage. It's a strength, but it reflects niche optimization, not broad based optimization. At the network level, the same pattern appears in trading. Just 1.7% of traders, whales, generated nearly 98% of volume, that is almost whole volume, over 80% of transactions, and roughly 60% of fees, while also paying the lowest average cost. Competitive pressure is also rising. Base now captures over 70% of layer 2 profit compared to Arbitrum's roughly around 15%, lightening the margin for error across the ecosystem.
Right. So now let's talk about some other kind of risks which are related to dependency and diversification. Now, concentration extends into governance and liquidity. The top 10 delegates controlling around 65% of DAO voting power, while retail participants make up more than half of the traders but contribute almost no volume. Now, that in itself is a dependency risks. What if whale activity slows or migrates? Liquidity and fee generation could fall in an instant. At the same time, the Dow Treasury declined from billions to millions, and this was driven by nearly 380 million in grant spending in the second half of 2025. Now, although that investment reflects ambition, it also raises the bar for sustainable and distributed returns. Now, from a public choice perspective, this outcome is quite predictable. Rational actors concentrate where incentives, liquidity, and execution, all of these are best. But these kind of also create a highway versus the side street sort of dynamic. The risk is monoculture here, efficiency today becoming kind of the fragility of tomorrow. So, what do you say about the governance and incentive implications from these?
So,
So, if we talk about the governance as well as incentive implication, these forces reinforces themselves. High performing chains attracts liquidity, liquidity attracts whales, whales reinforces both revenue as well as governance dominance. It's efficient but brittle. The solution isn't to penalize success, but to introduce counterweights, diversifies incentive designs, targeted support for mid-tier chains, and governance mechanisms that gradually reduce reliance on the top decile of participants. If we talk about the takeaways from a monitoring perspective, several signals matter the most. First, revenue concentration mirrors trading concentration. When three chains drive most orbit chains fees Fail drive nearly or volume, weekly top 10 revenue tracking becomes a core health metric. Second, mid-tier clustering is a leading indicator. Multiple chains sitting at similar revenue levels suggest potential breakouts. Retention and month-over-month growth, roughly 37% in quarter two, should be watched closely alongside grant outcomes. Third, the interventions are clear. Focus grants on diversification rather than pure volume, improve entity resolution to track cross-chain whale behavior, and continue adjusting voter incentives. Early signs already show top 10 voting power easing towards 62% in H2. What are your thoughts on this, Sariji?
I mean, as a closing thought, I can just say that Arbitrum's 2025 risk profile isn't a volume of warning, it's a signal of scale, sort of. The challenge ahead is a one of balance. How can we preserve excellence at the top while deliberately building redundancy and breadth underneath? How Arbitrum navigates this phase will determine whether it remains successful or, even becomes structurally durable. If we look at 2026 outlook and projections, Arbitrum's focus shifts from rapid expansion to long term sustainability. Aligned with the community's vision for the future of Arbitrum, the roadmap centers on building a neutral, open, and of course, Ethereum aligned roll up ecosystem. Now, this would prioritize performance, it should prioritize interoperability, and of course, decentralization. The aim is to target more than 50% of layer 2 market share. Now, that vision rests on three pillars. I think it measures on performance, unification, and at the same time, decentralization. So, what's your take on the performance at scale?
So
So,
when
if we talk about the one of these pillars, that is performance at scale, on performance front, 2026 is expected to mark a step change. The full rollout of bold permissionless validation, anticipated in early 2026, completes Arbitrum transition toward trust minimized security. At the same time, Stylus reaches maturity, enabling Rust and WebAssembly based smart contracts and driving up to 10x developer productivity, supported by speedrun style grant and deeper tooling. At a protocol level, RBOS Callisto integrates Ethereum Spectra updates, unlocking advanced account abstraction and tighter alignment with EIP 4844. Together, these upgrades push sustained throughput beyond 2000 transactions per second under real network conditions. That's a huge number. Orbit also evolves materially with improved interoperability and sequencing. Latency is projected to drop more than sixfold across a growing universe of 500 plus layer 3 chains. Automated revenue sharing frameworks could generate over USD 500 billion in annual DAO flows, reshaping Arbitrum's economic base. What are your thoughts about the unification?
Unification would mean like one Arbitrum stack. So by 2026, Arbitrum is no longer framed as separate networks. The scaling Arbitrum everywhere, the thesis actually unifies Arbitrum 1, Arbitrum Nova, and Orbit into a single execution and liquidity stack. Now, for users and developers, the experience becomes seamless. There are accounts that are shared, there is liquidity that is shared, and standards too are shared over here. While this all preserves customization at a layer 3 level. Now, this unification is expected to push TVL beyond $30 billion, driven by real world assets, gaming economies, and tokenized financial products. Early pilots, including tokenized assets and USGDP linked instruments, point toward Arbitrum becoming a core settlement layer for on chain finance. And I think that would bring us to governance and ecosystem evolution, that how would they evolve and what phases are they entering into.
So, governance also enters a new phase in 2026. After heavy grant deployment in 2025, The Dow Treasury is projected to rebound through time-burst driven revenue, potentially exceeding $5 billion annually, creating room for longer horizon planning. OPCO and Arbitrum grants take on a longer execution role, supporting 50 plus season 4 grants with a deliberate focus on mid-tier orbit chains and infrastructure rather than already dominant winners. Governance participation is expected to broaden. Unique voter counts could exceed 60,000, while reforms aims to dilute top 10 delegate voting power below 50%, strengthening decentralization credibility. On-chain activity continues to scale. Weekly DEXs and perpetual volumes are projected to double $20 billion, with Uniswap maintaining routing dominance, and platforms like GMX and Camelot anchoring derivatives and liquidity layers. By this stage, 1500 plus protocols operate across Arbitrum stack, supported by drip style incentive programs. At the same time, community scrutiny increases, stronger expectation around non-profit AAEs, open source mandates, and transparent onboarding.
I completely agree about this scrutiny. And I mean, there's a lot of things that are going on. So there are definitely risks that remain. Revenue and governance concentration must be managed meticulously and actively. The DAO is expected to pursue STIP style diversification, targeting 40% of ecosystem revenue from mid tier projects. This comes alongside mechanisms that bridge whale liquidity towards broader participation. Constitutional AIPs may further codify Arbitrum's core values. There, it might be neutrality, openness, and transparency, thus reinforcing accountable execution over closed decision making. The opportunity, however, I think is substantial. Ethereum's roll-up centric roadmaps positions Arbitrum to capture outsized growth as scaling demand accelerates. So, what do you think? How would you say that 2000 in 2026 the success will be measured?
So by 2026, success won't be measured by throughput or TVL alone. Key signals will include orbit latency and TPS, that is transaction per second post bold. The another point that it should include is arb unlock absorption without market disruption. The last that should be sustained broad-based governance participation. If those align, Arbitrum transitions from a leading layer 2 into Ethereum's most relevant institutional ready rollup, optimized not just for scale but for longevity. So here's the bottom line. This wasn't a hype cycle, it wasn't a matrix flex, and it definitely wasn't a victory lap. What 2025 showed is that Arbitrum has closed the hardest line in crypto, the line where systems stop breaking because they are new and start being tested because they actually matter. Scale is here, revenue is real, governance is messy, but no longer naive.
Huh. I mean, I think that is that is Arbitrum in 2025. Guys, the risks that we talk about today aren't red flags. As a community, as friends of this network, we need to understand that this is the tax that we pay for relevance. And 2026 is sort of a fork in the road. One path would be that of comfort, which would include concentration, inertia, and letting gravity decide the winners. The other one, if we look in the larger picture of what is better, would include something that is harder, a bit difficult. It includes diversification, has more accountability, and designing for resilience before something forces it. So now, Arbitrum, if and when gets this right, it does not just stay the leading layer 2. It becomes Ethereum's default execution layer. Neutral, institutional, and absolutely impossible to ignore. It not only would be optimized for the next cycle, it would be optimized for the next decade. And wouldn't we all love it? Because that's the moment Arbitrum is in right now. And for today, for the last broadcast of this year, that is where we'll leave it. As always, thank you so much for joining Lampros DAO Live. For every question, doubt, query, critique, or feedback, we are always open to you. Tune in, post to us, comment to us, write to us, email us, anything, and we will get back to you. I wish everyone a wonderful holiday season. Enjoy, relax, gear up because the future of Arbitrum and Web3 in general is exciting. And as always, it has been an immense pleasure to connect with you, with the entire community. Have a great, great time ahead. And as always, Arbitrum everywhere. Thank you so much.